but I presume he's talking about bilateral investment treaties and the simplification of that. Of course, it's an enormous network for countries to engage with individual countries across the world. They have hundreds of bilateral investment treaties signed, and that becomes very complicated. So I presume he was talking about some degree of simplification at the African level. If he was, on the other hand, talking about tax treaties, that's a different matter. On the tax issue, you know that ECA has been very vocal on the problem of lost revenue from the loss of revenues through the transfer pricing, multinational corporations, illicit flows, and is estimated to be as much as $100 billion a year lost through this way. There needs to be some agreement, I think, across African countries about the way we treat that. I have some personal views about the way forward. One is the problem of the arm's length principle, which is the principle which underpins the way multinationals are taxed on their profits in different jurisdictions. I think we need to look again at the arm's length principle. It's not working properly. Now, that's underpinned tax codes since the 1930s, the arm's length principle. But because we live in a global economy where multinational firms have so many intra-firm transactions, it becomes very difficult for tax authorities to actually determine how much of the profits that are actually being declared in their countries are taxable and how much are being transferred abroad. So I actually think we have to start afresh and think of new ways of implementing taxation on the operations of corporations with activities in many countries. It would be very helpful at the African level, for example, to have some agreement on the way forward on this. Now, the declarations I've seen so far tend to be on having more transparency about information on what companies are doing. I personally don't think that works very well in practice because we've been asking for more transparency for many decades. And it's only little by little do you get some agreements on that. But I actually think we have to maybe think outside the box and look for new ways of looking at taxation treaties.
Now, in regards to what you mentioned as the ECA, there was a question on holes that could come up, and it was written in an article. Now, within the different nationalities, the different countries, the issue on the national budget is on a macro level. But when we come to the AFCFTA, national budgets are in the micro economy of things. Now, you mentioned about having a hole in our national budgets. If we worked out a hole, a possible hole within the scheme of things, if we are not able to service our national budgets, how do we work out a system where different nationals, different countries can now fit into plugging money into the larger context of things? That was in your East African some time back, so I would love to hear your view on what you meant with that.
I don't actually remember that comment about a hole in the budget. There is concern over rise in budget deficits and debt in general in Eastern Africa. I mean, that's mostly explained by the ambitious programs of infrastructure development we see across the sub-region. Now, I think the case was made here in the plenary. You know, it's very important that countries continue to invest in that infrastructure, but it does have to be done in a sustainable way. And a number of countries in our region are getting to quite high debt levels now, so Kenya's approaching 60% of GDP, for example. And I think that does raise some concerns about the vulnerability of our economies, because although our economies have debt to GDP ratios which are far below the ones you see in the West, so you'll see some high-income countries with debt to GDP ratios in excess of 100%. For developing countries in Africa, we're vulnerable at lower levels of debt. So we have a couple of countries in our region now which are at high risk of debt distress, according to the IMF, Djibouti, for example. I think these countries need to look again about how they're financing the infrastructure development, because we fully support what they're doing in terms of investing in port infrastructure or roads. This is all transport in general. This is all very important for the long-term development of the region. But at the same time, they do need to be fiscally clever about how they do that. You know?
A final point, preferential market schemes, whether they work, whether they don't. We have AGOA we could look at, whether this has worked for certain countries. So what's your view on a holistic approach on this?
Well, yes, I think we started to discuss this over, the last time we spoke on television. Yes, my personal view on preferential market access is over the long run, it's really not the way forward. We've had AGOA in place now for the last 18 years. We've had the Everything But Arms agreement for the European Union. Special and preferential treatment actually has been embedded in international trade negotiations since the 1970s. And yet we haven't really seen the diversification of the economies that we expected for. We haven't really seen strong export performance. With agreements like AGOA, you see some countries benefiting, but it's relatively marginal, and it's not really supporting the diversification of the economy, the export performance. So in EEAC, I think we discussed Kenya is the only country which has significantly benefited from AGOA. I think the way forward is not preferential market access to high-income economies. Those schemes don't work in practice as they were originally intended to. And that's why ECA is so supportive of the African Continental Free Trade Area, because this is non-preferential market access amongst our own economies. And we see that the intra-regional component of trade is very dynamic. But it could be made much more dynamic by reducing the tariffs on intra-Africa trade and by removing those non-tariff barriers. So I think for the longer term that would be a much better basis than the preferential market access. I could go on a little bit if we have the time to explain why the preferential market access hasn't worked as it should. One reason is actually when these programs were initially designed, actually high-income countries had high tariffs on industrial goods. Hence, there was an incentive towards exporting on those tariff lines where the preferential access was largest. It was meant to diversify economies. It didn't actually happen, and that was partly because of tariff erosion, because those tariffs came down over time. So industrial tariffs in high-income economies like the European Union, they're probably about 3 or 4%. So preferential access now in those areas doesn't really give you much of an additional incentive. The other reason, I think, for preferential market access not to deliver as it was supposed to is because it's granted on a rather arbitrary basis. So we've seen in our region, for example, Madagascar was suspended from AGOA because of political problems at home in 2008. That really caused some serious problems with the export industries that were based their success on the AGOA agreement. And I think whenever you have an agreement which is conditional on fulfilling certain other conditions, you're going to have problems further down the road. So we've now just recently seen Rwanda has been notified of a suspension from AGOA because of the disagreement on the textile sector, because they want to ban the import of second-hand clothing to incentivize the local textile industry. That, I think, is indicative of the kind of difficulty of building up industrial capacity under these agreements, precisely because what's given to you one day could be taken away again next. So I think we need to move towards more secure trading arrangements, and the African Continental Free Trade Area obviously is a key priority, I think. Yeah.